Thailand, the land of smiles, is more than just beaches and temples. It's a nation quietly navigating global economic turbulence with resilience. Despite global shocks, from financial crises to a pandemic that crippled tourism, Thailand's recovery has been steady, not spectacular, built on a diverse economic base. The country's stability comes from three pillars: a powerful tourism sector, robust exports, and strategic public investment. The challenge now is whether this model can withstand new global headwinds, like geopolitical tensions and slowdowns in China and the US. Thailand's story is one of balancing domestic strengths with global volatility, using targeted policies to boost tourism, advanced manufacturing, and infrastructure. As we look ahead, Thailand stands at a crossroads, facing high household debt and an aging population, but also equipped with strong fundamentals and a proven ability to adapt. Thailand's economic resilience faces five major challenges. First, household debt remains alarmingly high, over 90% of GDP, limiting consumer spending and making the economy sensitive to shocks. Second, an aging population is shrinking the workforce and straining public finances, demanding urgent investment in automation and upskilling. Third, the recovery is uneven. While tourism and exports thrive, small and medium-sized enterprises struggle to access credit and adapt to digital change, widening inequality. Fourth, as an export-driven economy, Thailand is vulnerable to global slowdowns and trade tensions, especially with key partners like the US, China, and Japan. Fifth, political uncertainty lingers. Even brief instability can disrupt investment and delay reforms. Policymakers must address these pain points to ensure stability and inclusive growth. The government's challenge is to balance short-term relief with long-term reforms, especially in debt management, workforce development, and political stability. Without decisive action, these vulnerabilities could undermine Thailand's progress. The stakes are high. The right policies could unlock new growth, while missteps risk stalling the country's momentum. Thailand's future depends on how it navigates these interconnected risks. The next chapter will be defined by the government's ability to adapt and lead. The world is watching to see if Thailand can turn its challenges into opportunities. The path forward demands both discipline and innovation. Thailand's economic recovery in 2024 and early 2025 has been steady, with GDP growth around 2.5–3.5%. This stability is driven by a rebound in tourism and resilient exports, offsetting weak domestic demand. Unemployment remains impressively low, about 1%, thanks to labor market flexibility and a large informal sector. The Bank of Thailand has kept policy rates steady at 2.5%, successfully curbing inflation within the 1–3% target range. Public debt has risen to 63% of GDP, but remains manageable and below the government's ceiling. Fiscal discipline and a clear consolidation plan have preserved investor confidence. The government's careful balancing of stimulus and restraint has kept the economy on track. Thailand's fundamentals remain strong, but continued vigilance is needed. The country's ability to respond to future shocks will depend on maintaining this delicate balance. Thailand's growth engines are best seen in action. Phuket's rapid tourism revival, led by the Sandbox program, brought international arrivals back to near pre-pandemic levels, reviving local businesses and jobs. In manufacturing, Thai automotive and electronics firms adapted to global supply chain shocks by diversifying markets and upgrading production, especially in the Eastern Economic Corridor. Major infrastructure projects like the high-speed rail connecting three airports are transforming logistics and attracting private investment in advanced industries. These successes are interconnected. Improved infrastructure boosts tourism and exports, while public investment crowds in private capital. The synergy between government action and private sector agility is driving Thailand's recovery. Each case study highlights a national strategy focused on resilience and competitiveness. The Eastern Economic Corridor is a model for integrating infrastructure, industry, and innovation. Thailand's momentum comes from aligning public investment with private opportunity. This virtuous cycle is key to sustaining growth. Thailand's economic drivers are deeply interconnected. Tourism fuels private consumption, creating a ripple effect across local industries and boosting household incomes. Public investment in infrastructure, especially in the Eastern Economic Corridor, strengthens the export sector by lowering costs and attracting foreign capital. Business confidence rises as government projects progress and tourist numbers climb, spurring private investment in technology and capacity. This synergy creates a resilient, diversified economy, If one sector falters, others can cushion the impact. The government's role is to catalyze this interplay, ensuring tourism, exports, and investment reinforce each other. Thailand's steady performance is built on this web of mutual support. The challenge is to keep these engines aligned and responsive to change. A balanced, multi-pronged approach is Thailand's best defense against future shocks. The country's economic strength lies in its ability to weave these drivers into a cohesive growth strategy. Thailand's progress is real, but risks remain. High household debt leaves many families vulnerable to shocks, threatening consumption and financial stability. Externally, a slowdown in China or persistent inflation in the West could hit exports and tourism hard. Political uncertainty, though currently subdued, could quickly erode investor confidence and delay key projects. Long-term, Thailand must address its aging population and skills gap to avoid the middle-income trap. The transition to a high-value, innovation-driven economy is urgent. Without bold reforms, these risks could stall Thailand's growth story. To secure its future, Thailand must act decisively. Reducing household debt through restructuring and financial literacy is essential to unlock domestic demand. Investing in education and workforce upskilling will counter demographic challenges and prepare for a tech-driven economy. Diversifying beyond tourism and traditional exports by supporting startups, green industries, and digital services will build resilience. Policy continuity and efficient institutions are vital for investor confidence and long-term projects. Streamlining bureaucracy and strengthening the rule of law will make Thailand more attractive to business. The outlook is positive, but realizing Thailand's potential requires discipline, vision, and relentless reform. The next phase of growth depends on turning these recommendations into action. For more data-driven insights and global market breakdowns, subscribe and turn on notifications. Stay informed, stay ahead. This is Economics FX, where clarity meets strategy. Until next time, trade smart.